What's going on, everybody? Good evening. Told you I was going to come back with some traditional finance videos, and this is the first one of a few that I'm planning and will deliver to everybody. This one is the topic of mutual funds. For those who may have been invested in it before, may have not understood what the mechanisms of a mutual fund is, I'm going to explain pretty much in three parts. One, what it looks like on a macro sense. Two, the types of individual mutual funds that are available. And then three, how you would actually purchase one if you're going to put money into it. So let us get started with my whiteboard. Here we go. So in essence, the very basic definition of a mutual fund, I'm going to give you how I explain it to clients. And basically, it is a company that invests in other companies. I try to avoid the word stock because stock, particularly to middle class America, is always seen as risky. But it's a mixture. It could be a mixture of stocks, could be a mixture of bonds, some of which, depending on their investment strategy, could be low yield, could be high yield, could be somewhere in the middle. So usually what they'll have is each fund will have about 150 to 200 holdings in each fund. I'll show you what that looks like on a very basic, crude level with my bad circle that I'm drawing here. And obviously, I'm not going to draw 250 boxes here, but I'll draw 9 just to kind of illustrate it. Some mutual funds will have their hand in pharmaceuticals. So Merck as a company might be one of them. Maybe even some social media tech. Facebook might be another holding. They also might get into some other tech. Tesla could be another holding. And to balance it out, for something a little more steady, they could put Ford as well. May invest in soft drinks, Pepsi, for those who like it, Coke, for those who do and don't as well. Maybe somewhere in the middle is Amazon. They could have another holding there in Amazon. Also, still in the pharmaceutical industry, they could have Pfizer as part of their holdings as well. And maybe even on the other side, Google. Now, just expand this a little bit to about 100, 250 different companies, and you have ultimately what a mutual fund in its ecosystem would look like. Now, the key to this is that this particular fund will have a share price, and otherwise known as a net asset value, which is probably the same thing as a share price of a stock or a bond, but it's calculated differently because these are actively managed funds by traders during when the markets are open, 9:30 to 4. This is what they do. They actively manage the money that comes into this mutual fund. They trade, buy, sell. They even do options as well. They have to disclose that in their prospectus if they do. But at the end of the day, if the net asset value or share price is $10 and their trades go well by the end of the day, the net asset value of that mutual fund is calculated after the markets are closed, usually by about 6 o'clock p.m. So on Monday, it could be $10 a share. And then by Tuesday, they do a bunch of trading during the day and it goes up and it could be $10.25. Wednesday, maybe they have some bad days in the market, whatever the case may be, then it drops to $9.60, just to kind of give you an example. So really during a business week, Monday through Friday, the share price and the net asset value of a mutual fund is only going to change 5 times. Monday, Tuesday, Wednesday, Thursday, and Friday after markets are closed. Now, if markets are closed for holidays, long weekends, Memorial Day, things of that nature, obviously there's no change in the net asset value. So when I get to the third part of this video, I'll show you what that would look like when the money goes in and which price you would actually get depending on the timing of the trade that you put in. So I'm going to give kind of an analogy that helps people understand this when I explain a mutual fund, because the key to this is that you're buying shares of the fund itself. You do not have ownership or equity or custody of the individual holdings in that mutual fund. Simply because you buy shares in a mutual fund does not mean you own Amazon stock or Facebook stock or any equity or shares in that. You own the share price of the fund that manages those different holdings in those different stocks. If the fund manager decides to get rid of Facebook because it doesn't like the direction it is going in and replaces it with some other tech stock, they have full discretion of that because they are actively managing that mutual fund. These are usually your Series 7 guys that you see in Merrill Lynch and Wall Street that go to work for a mutual fund company so they can become, well, the idea is, you're becoming a portfolio manager and then you'd work your way up to be vice president, senior vice president over the portfolio itself. And they make money off of the total assets under management, they call it, as these are traded. So here's my kind of analogy that I use. Say you were going to make an omelet with 100 eggs, which is a pretty big friggin' omelet. And as you're trying to make this omelet, one of those eggs drops on the floor. But you go ahead and make the omelet anyway with the 99 eggs. When you serve it to whoever is eating the omelet, would they be able to tell if one of those eggs had dropped on the floor? My answer would be no, not at all. And that's the concept of the diversification benefits of a mutual fund. You're investing in a fund that if one of them tanks and goes tits up, you still have 149 to 199 other holdings that can keep it up. Whereas if you decide to invest in individual stocks, by contrast, and you have all that money in that one stock and that one business goes tits up, then your entire money that you put into that stock also goes tits up as well, evaporates, vaporizes, as Lou used to say. So the other side to this is, and I'm going to make fun of Pepsi because I can't stand that shit. It tastes like battery acid to me. Let's suppose Pepsi is that holding that goes tits up. Goes to zero. Pepsi goes out of business. Been praying for that for 40 years now. Well, what do you think is going to happen with a holding to Coke now that Pepsi is no longer? Chances are it's going to be balanced out not by just the other holdings in the fund, but the competitor of the actual holding underneath that went out of business. I think Coke stock would go up if Pepsi went out of business. Just a amateur piece of advice or speculation on my part, but I think it's reasonable to suggest that, at least looking at this. So mutual funds, like I said, have been around for 100 years. There is a very long track record to them. And I'm going to go into the types of mutual funds that you're normally going to see, because one company, and I'll throw one out there. I'm not recommending this company. I'm not recommending any of their funds, but Invesco is a good example. You've probably seen those stupid QQQ commercials for the past year and a half. Invesco is a mutual fund company, but they have a bunch of different funds depending on their investment objective underneath them. And I'm going to go into that now. Keep that visual in mind. Keep the analogy of the eggs, the omelet with 100 eggs in mind, and why people feel comfortable investing in these products. So there's really only three things a mutual fund is going to do to keep this simple. I'm going to keep a continuum here. One, it's either going to provide income. Two, it's going to provide growth. Or three, it's going to provide a mix of the two. You'll probably see them as growth and income funds, sometimes labeled as equity and income funds, just depends on their objective. So to show you the ecosystem of what this looks like, on the low end, we've already discussed municipal bonds. We'll just call them munis. Probably have a 1 to 3% yield for a municipal bond. Not a lot, but the advantage of it is, depending on the municipal bond that you get, income tax free. Now, there are some municipal bonds that you can get that have 7, 8% yield, but chances are they're also not solely invested in municipal bonds to provide that tax-free income. So usually if you're going to find a tax-free municipal bond, it's because it's got the lower yield. They're not exactly aggressive performing investment instruments. They're designed to stabilize and preserve what you currently have and then provide you a little bit off the top. Now, Getting out of municipal bonds, you may find bond funds that are either private corporate bonds or even treasuries as well. On average, not all the time, but on average, they'll probably perform in the 4 to 5% ratio. So a little bit more growth than just a pure muni bond on the income side, but not necessarily in this middle spot where they don't have bond funds, don't have stocks in it to balance it out. Bond funds are just that. Their investment strategy is bonds, so they can preserve capital and also provide a little more income than a municipal bond would. Now, in the middle, you're talking about what I would call equity and income funds. So it's got a little bit of a mix of bonds, probably on the corporate side and treasuries, and then also some stocks and equities. And usually, not always, just depends on the performance and their investment objective. You're going to look mostly at equity and income funds in the 6 to 8% range. And then you're going to go a little bit closer to the right side. You're going to find growth funds. This is primarily stocks and equities, like 95% and above, whether it's large cap or mid cap, going to provide you probably somewhere in the 9 to 10% range on a rate of return annually per year. And then on the very far end of this is where we've heard, is it aggressive growth or not? Some of them are, but I consider anything 11% plus to be what we would call an aggressive growth fund. You usually find these with small cap funds because they are small cap companies. They have the largest room to grow from a rate of return spot, 11 and above. What I've usually found out, at least with the mutual funds that I offer to clients, is that for us to trust any of these numbers, to see a track record, there's 3 things I look for. And those 3 things are: 1, I look for at least a 25-year track record with these rates of return in order to feel comfortable actually recommending to somebody, to make a recommendation to a client. And the other thing that you need to think about is that it will match also your investment objective. And that objective could be a couple of different things. It could be an emergency fund. It could be college savings for your children. It could be retirement. Or we'll just put this as other. Maybe you're saving for a boat. Maybe you're saving for a down payment for a house. Maybe you're saving for a trip to Europe because you have family over there, whatever the case may be. The idea behind this is that if you're going to get 11% or more on something aggressive, you're looking at least a 7 to 10 year plus time horizon. That's not going to help you if you're trying to set up an emergency fund. That will help you if you're setting up retirement. So the objective and the rate of return on the funds has to match your goals. This is the first thing I discuss with clients as I'm looking at this. An emergency fund is something you want to set up within a year. Yeah, well, if you're depending on something aggressive to grow over the course of 10 years, that emergency fund is it's not going to help you, because as aggressive as it could be on the up end, aggressive funds also have down ends too. So you could be putting in principal and losing it within the first year or two on an aggressive growth fund when you need to have an emergency fund sooner rather than later. So keep in mind that you're looking for a 25-year track record for these percentages, and also match the objective of what you're trying to use this money for. These are the types of questions that I would ask clients. And then third thing is that a lot of the prospectuses for these mutual funds, I will do a separate video on how to read a mutual fund prospectus. But what they'll do is they'll show a 10-year history within that prospectus, just to show you what it's done recently. What have you done for me lately type thing. A mutual fund, you're going to see roughly 2 to 3 years of positive returns for every 1 year of a negative return. If you see a bunch of negative returns in the past 10-year history in that prospectus for the mutual fund you're thinking about investing in, chances are it's trash. Don't put your money into it. Again, when I go over a prospectus for a mutual fund and how to read it, I'll show you that section of the prospectus and show you what their track record would look like in the past 10 years. Again, I don't go by 10 years just to make my decisions on investing in it or recommending it to clients. I use 25 years for that to see, or their inception. I have some mutual funds that go back to the 1940s. I have some mutual funds that go back to the 1960s, and I have mutual funds that go back to the 1980s. So you have a 40 to 80-year track record there. If you can see since that inception that it's 11%, 12%, 13%, some of them, then you know at least comfortably past performance doesn't indicate future results. But if they have an 80-year track record of, you feel pretty confident that the fund managers are sticking to that objective and are going to produce results for you. It's not guaranteed. Like any investment, do your own research, make your own decisions. But this is the guiding light that I give to clients and even myself when I'm doing value investments for things like a mutual fund. All right. Third spot I'm going to hit is what this would look like on a practical end if you're going to invest. I'll use the green pen. So what does this look like? Money for active management. As I've said before, nobody works for free. And mutual fund managers, investment portfolio managers, and even their higher ups are the same deal there. Mutual funds by law are capped at about an 8.5%, what they call load, otherwise known as a sales charge. And I'll focus only on A shares because A shares are charged up front. Now, some it's low as 3%, some it's low as 7%, or as high as 7%. So we'll just do, to keep the math simple, what a 5% sales charge or load would look like, just for math purposes to keep it easy. So here's the example I can give. Let's suppose you have a mutual fund and their net asset value or their share price is $20 per share. And you have $100 to invest. I want to buy the shares of this mutual fund. I have $100 to throw into it. Here's what it will look like, the 5% sales charge. 5% of that goes to the mutual fund company, the managers, to actually pay their salaries to actively manage that fund Monday through Friday, 9:30 to 4. So while we're at work in the office, we don't have to look at the ticker every second to see what we're investing in. We're outsourcing our trading proclivities based on our own goals and objectives to a professional who does this for a living. So $5 of that would go to the mutual fund company, which means the other 95%, or $95, would go to your investment, your portion of the share. So if it's $20 per share, you divide 95 by $20 per share. And what you have at that point is 4.75 shares of that mutual fund. Now, if you have a systematic investing plan and you put $100 a month in, that's pretty much what it'll look like month over month. So this is per transaction. These are not short-term investments. These are not something that you buy on Monday and sell on Wednesday, because there is money that goes into this that you will be spending to the tune of, let's say, 5% for math purposes. But let's say you have a monthly plan, you spend $100 a month. Roughly, if the mutual fund stays at 20%, $20 a share, it could go up to 21, it could drop to 19, whatever the path in the chart would take based on their activity for trading. But let's say over the course of a year, you buy 4.75 shares. Over the course of a year, you would end up with over 50 something shares of that mutual fund, and you would be participating in its growth. I'll go over, when I go over the prospectus, I'll show you what that looks like on a compounding effect, and why mutual funds have been a popular item for definitely even middle income America over the past 100 years. Even though in the early days they weren't regulated for those first 10 years, and once the New Deal investment laws happened, 1933, 1934, It's been pretty much a regulated industry since then. This is what has been comprising most, if not all, of 401k portfolios or even individual IRAs and Roth IRAs. And I'll say this and just kind of end it on this because I've talked to some of the more successful people that I've known and come in contact with over the years, real estate moguls, business owners, sharks playing international monopoly on that scale. The They've invested in a lot of stuff and a lot of risky cowboy speculative shit. Now crypto is kind of in that new wild west cowboy shit world. But they've always said, out of all the things I've invested and made money in, thank God for my steady investment into mutual funds, because they have given me a predictable, constant rate of return based on my investment strategies, not too aggressive and not too low, maybe in that equity and income realm. But the track record is there, and I'll walk you through the different types of funds when we do the prospectus analysis. I'll probably pick 3 separate funds randomly that I don't offer to clients, but just to show as an education side of it. And then I'll show you how compounding interest works in the world of mutual funds based on that 10-year track record, and then also longer as well. So hope this was helpful. Hope it cleared the fog. Again, company invest in other companies, bunch of different holdings. If one goes tits up, the others will keep it afloat. Think of the egg and omelet analogy. Think of the 3 things that a mutual fund is going to do. It's going to be either provide income, growth, or somewhere in between. And my 3 rules for investing in a mutual fund. And then also here's the practical, technical, tactical part of how it works. Where if you shove in $100, a percentage of it's going to go to the mutual fund company to manage it, and the rest of it's going to go towards your investment and your equity in that company, in that fund, with that share amount based on the price. So hope this was helpful. Hope this was useful and enlightening. Again, giant hugs.